Winter is coming.
There's been a lot of talk in the press just recently about the possibility of a long, dark winter in the property market. And that's got a few people spooked. So we figured today it was worth diving into that and trying to cut through the noise, make some sense of it all, and to talk a little bit about what's really going on and what we as investors really should be thinking about, doing about it, and focusing on so we don't get caught up in all of that noise. There have been a couple of headlines just in the last 24, 48 hours that are really interesting to look at and try and unpack. So we've got Macquarie's economists tipping an extended period where they think that home prices will grow no faster than inflation. And if I take their actual quote, they're talking about the tax changes in particular. They've said, if implemented, the recently proposed tax changes would add to our conviction that there will be little to no price growth over the coming decade or two, with a risk that we're now on the cusp of another significant fall. Now, that sounds like doom, Brendan, for property investors.
You are talking winter, Simon. You are talking winter.
Yeah, the White Walkers are at the gate, and we better be prepared for two, not one, but 2 decades of darkness and chill in the property market, possibly significant falls. So,
well, AMP's chief economist, Shane Oliver, said something similar.
Yeah, not quite as dramatic perhaps, but he made a comment that he's seeing a potential home price fall of ballpark 5% spread over this year and next year. But he has spooked some investors by saying, and again, I quote, the 30-year super cycle upswing in prices may be close to over. There's a couple of things in that, Brendan, I'd like to try and unpack. I mean, for one thing, I'd like to call BS on the idea that we've had a 30-year super cycle price upswing in the property market. I know, and you've been investing for decades as well, based on our experience, we've seen over the past 30 years plenty of periods where prices in different parts of the country have been flat or down for extended periods of time. I can recall Sydney's market between about 2003 and 2010, 11, 12. It was really flat down for a long period of time, didn't keep up with inflation at all. Prices in inflation adjusted terms didn't really go anywhere for 10 years in Sydney, if you look at the median.
References to some really macro data points.
Yeah.
Typically, they're talking about pick a number over a 365-day period that represents a growth of the entire country in that time frame. One number. You get one number to represent that. And then if you graph all those one numbers together, then you get a broader trend up without those fluctuations. So the super cycle modeling is centered on, I've got a number as a representation of growth over a 12-month period since the, 1900, early 1900s. And look, there's a growth period, our super cycle of 30 years. So there's a real disconnect between the reality of investing and the representation of growth. That said, though, yes, there's been growth, but without any other context around it, you're setting yourself up for potential misinterpretation.
Yeah, and what's the saying? Lies, damn lies, and statistics. And you can make the numbers say anything you want if you want to get an attention-grabbing headline. So,
and it's all a matter of the points of reference that you choose. But anyway, the point being, though, there has been a lot of talk in the media around the idea of, for a period of time or since capital gains tax and negative gearing came into play, that it's inflated prices through investor buy and hold activities. And this is the end of that, and went for a long winter after that. And yet that may or may not be the case. I'd like to suggest that there are some fundamentals at play here that are going to contribute to the continued growth of property. And it goes back to your basic economic principles of supply and demand. Simon, you and I have seen at a micro level supply and demand play out and aggregated up to a macro level supply and demand playing out. And right now we have a broad supply shortage with a growing demand given the population growth from migration and the fact that housing is very difficult to get through the red tape and expensive to actually produce, with limited incentive for developers, private developers, to want to do it because the margins aren't there right now. So the problem's a long way from being solved, such that we are seeing the end of the shortage of supply. So to that end, yeah, no, we're in an environment where there are some fundamentals at play here that are still going to influence the market. So I'm not clear that there's going to be a long winter in property, at least for 1 or 2 decades, where there's no growth,
Yeah.
or no growth above inflation.
Yeah, and there are some wildly differing opinions out there, and this is one of the things we've always seen with commentators and economists, that even the economists don't really seem to understand economics 101 at the best of times, and this whole supply-demand equation that really fundamentally drives prices. We had the CBA come out yesterday. Here's a great example of why you shouldn't trust the headlines, especially at the moment. So you had the headline say CBA now tips 5% house price fall as multiple headwinds hit home. Now, that was the ABC News just yesterday. So CBA tipping a 5% house price fall. Did they? If you actually read the article, this is what CBA actually said. CBA said, we now expect national dwelling prices to be flat over 2026, down from a forecast of 3% at budget and 5% at March. So what they're actually saying is no, we're not saying there's a 5% price fall. We're saying we'd previously predicted a 5% price rise, and now we're saying it's going to be flat. It's been utterly misreported as a predicted price fall, when in fact all they're saying is no, our forecast has been revised down by 5% from a 5% increase to 0. They also said in the same article that home prices should stabilise and lift in 2027 as lower prices see borrowing constraints ease and higher rental yields bring buyers back into the market. Our expectation for lower interest rates in 2027 should also support a recovery in prices, but there's a degree of uncertainty around the cash rate outlook. That's what they actually said, which isn't at all what the headline said, is it?
No, it's not. So and I go back to your comment earlier about lies and statistics. The comment is, we now expect, according to what came out, we now expect national dwelling prices to be flat over 2026. What does that actually mean? Does that mean that we're expecting to the back end of 2026 that the market will flatten out, or not? Because if you read that as flat over 2026, basically that's telling us from 1 January 2026 to December 31, 2026, prices will be flat, according to that literal sense of that word. Now, if that means that we've had some growth in early 2026, that means it has to actually come off that growth and decline to have that data point and that data point equal each other to demonstrate flat over 2026. I think what's more relevant to look at is what's happening in a shorter time frame. Annual statistics are really difficult to understand a market from. And there's a lot of reference to annual statistics out there right now about growth in this year and growth in that year. And it's flawed because, again, people assume when it's spoken so loosely, people assume that it is a representation of the nature of the market for an entire period length, when in fact it's not. And there is so much volatility that occurs on a monthly, weekly, quarterly basis. Our encouragement is not necessarily to look at macro numbers, particularly not when you're buying a property, particularly not when you're investing for yourself, or you're looking to buy, or you're looking to make a decision to sell, or you're looking to figure out whether I should do a long-term project or a shorter-term project, or whether I buy, hold, hope and pray.
When it comes to understanding the market and how you should behave and what to listen to and what not to listen to, you've really got to bring your investing back down to, I'm not buying Australia, so I really don't care what's happening with the Australian median price. In fact, I'm not buying Sydney or Melbourne or Perth or Adelaide or Brisbane or an entire city. I'm buying a property in a suburb to make money from in some specific way. So what I really care about is the fundamentals, the balance of supply and demand, that economics 101 down at the individual suburb level. And that's where I should be focusing my attention. Property price behavior is a function of supply and demand, which is exactly what we've talked about on multiple occasions. And you do have the issue of suppression of some demand, particularly for investors at the moment, because of higher interest rates, tax changes, uncertainty, and some of that affects owner occupiers as well. So you've got some things that will suppress demand generally. But you've also got issues that are actually constraining supply. I mean, you mentioned, we've got a pre-existing shortage of housing versus population growth, Brendan. These tax changes that we've just had effectively incentivize established investors to retain the properties they have that they might otherwise have listed for sale over the next year or two. And so that constrains supply that would otherwise have hit the market as well. And that mitigates against these sort of deep price falls that some are claiming are coming. The economics doesn't really support that argument when it really does come down to that balance of supply and demand. So that's going to mitigate against deep general price falls. But we've got to bear in mind that there is no one single Australian market. Everything comes down to the fact that we've got thousands of localized markets, each with their own different balance of supply and demand. And our job as investors is to understand, well, what does that balance look like in the individual suburbs that we're dealing with? Do we have an imbalance of demand over supply? That means we've got upward price pressure that still works in our favor if we are trying to get some shorter term growth out of the property, or we're trying to mitigate our risks and mitigate against price falls. What is that balance in the suburbs that we're looking at? What else could we be doing? We should be looking at how we actually manufacture growth. If broad-based growth is less certain, what can we do to actually manufacture growth? Renovation, subdivision developments, active strategies. What can we do to create cash flow so we're generating income off the property rather than relying solely on market-driven growth? And obviously, members of the Results Mentoring Program are very well placed to apply those kinds of strategies because they're trained up in that. And so they'll be able to seize the opportunities in the current market and really see through this noise and apply this stuff. But it is very easy to get caught up in that macro noise and forget that how the property market actually operates is that balance of supply and demand at the individual suburb level. And I can have a suburb that's going up strongly in value because of a lack of supply and strong demand in that suburb, and other suburbs that are oversupplied and prices are eroding or going down, and I'd want to avoid those suburbs. That's really the decision-making process that we should be focused on as investors, not getting caught up in the hype, the headlines, the winter is coming of the property market, looking at, well, what's actually happening in the suburbs where we're operating.
There are 20,000 individual markets playing out in this country at any one time. 15,000 suburbs, 5,000 of those have units, 20,000 individual markets. When the broader Australian market is perceived to be climbing in value, then there's a higher percentage of those suburbs that go into growth. When the broader Australian market is determined or deemed to be in decline, then there is a much smaller percentage of those in extreme growth. But that doesn't mean that there is no growth suburbs, and it doesn't mean there is no declining suburbs in a high growth market. So the point then is, and Simon's speaking to, get into the suburb level, because at a suburb level, there are idiosyncrasies, there are demand and supply pressures that exist at that level that allow you to get into a suburb for projects. If you look at short-term statistics for the purpose of, I'm doing a short-term project, 6 months, 12 months, 18 months, 24 months, up to 3 years. If you're looking at that sort of time frame for a manufactured growth project, you must look at individual suburb level. See, there's a lot at the moment, and I'm speaking into the positivity of these areas. If you look at the moment, there's a lot of infrastructure coming to completion. That infrastructure is going to change the dynamics of individual suburbs around where that infrastructure is. They are great opportunities to go into just prior to completion, to purchase, to ride the wave of micro growth that exists as a result of that, so that you get significant uplift in the profitability of the project you take on. That's going to serve you well from the perspective of making money even when you've got dark winter in the property market as an overall. So the implication then is, while there is news out there, and particularly in the headlines, Don't listen to the headlines. As Simon said, read the article. Headlines are often wrong. They're a clickbait magnet. Um, but don't invest based on the headlines either, or even on the articles. Invest based on the dynamics that you've got in your area relative to the strategy you want to take on and the serviceability of the numbers that you have for that particular project.
The main reason we read the headlines is to understand how the less educated will respond to that and behave, and then try to see the opportunity in that. Bring it down to that individual suburb level. Focus in on the strategies that aren't so reliant on broad-based growth. Buy, hold, and pray shouldn't have any place in your portfolio right now. That is a very outdated strategy, especially in the current environment. Keep an eye out for things that could change sentiment moving forwards. Whatever happens in the Middle East, if we actually see an end to that conflict and a reopening of the Strait of Hormuz, that will improve sentiment. That could play into people's decisions in the property market. Keep an eye on what does actually happen with interest rates. If we do see, as the CBA is forecasting, a rate cut or two next year, then that could very well play into sentiment in the market as well and stimulate demand by increasing people's borrowing capacity. So watch those things by all means, but bring your decisions down to that micro level. What's going on in the individual suburbs that I have an interest in? Where's the opportunity? Where's the growth? Where's the risk mitigation? And how do I manufacture growth and manufacture cash flow in order to be able to build my wealth and take advantage of the opportunities in the current environment?
If you are new to the Property Pulse, welcome. If this is the first one you've seen, I hope you've been entertained by it, and I hope you found it a little informative. If you're a new member and you haven't filled out your profile yet, can I encourage you to go into the top corner of your screen and fill out your profile, make sure that all the appropriate information is there. That helps people find you to have the conversations that you might want, helps you find others to have the conversations that you want. Make sure you turn on notifications so that if somebody does reach out for a conversation, you're going to get notified that they want to talk, which would be just awesome. Introduce yourself, say hi, answer the icebreaker question, become part of the community. There's a huge amount of resource inside the real estate success community. There are also events coming up, so RSVP to those. Question, asking for a friend. Does the grandfathering investment properties owned before budget night mean that she can continue to negatively gear as long as she continues on that property, but if she sells after 1 July, that she'll get the 50% discounted capital gains up till then?
The milestone dates were budget night in terms of ownership for qualifying properties, and then the CGT tax change kicks in from 1 July 27, assumed legislated. Ditto the negative gearing. So we covered this in some detail in a very recent session that we did, which is also in the event replays. So I'd encourage you to look up the new rules of property investing in the event replays, where we unpacked some of the key changes in the budget and specifically around these sorts of issues and timings.
If you haven't seen that, I encourage you to go and have a look. Guys, we wish you the very, very best. And until we meet again, invest wisely next Thursday. See you guys.
See you guys.